My name is Anna Myers. I am the Vice President of Grocapitus, and we are so thrilled to have here with us my friend Dugan Kelly, who is also our lawyer on our current project, Coyote Creek, which we're super excited about. And this is the first project that we're doing, although we've been ramping up for it, that is 1031 eligible. And we've gotten so much interest because of that. And so I wanted to have Dugan come back and explain to our potential investors what it means to 1031 into a syndication. Because if any of you out there are like me, when I asked, I'm like the 1031 queen. I'm on my sixth and seventh 1031 right now personally. And when I've asked in the past, can I 1031 into your syndication, Mr. Syndicator, I was always told, no, you can't 1031 into my syndication. It just doesn't work. You see, you're relinquishing one property name, you're going into an LLC. It can't work. And so I was always like, that's so frustrating. But guess what? It can work. Dugan is here to tell us how it can work.
What is a 1031 exchange? So simply, it is a reference to the section of the IRS tax code that allows, in this case, property owners, real property owners, to sell one or more of their properties in exchange with one or more like-kind replacement properties. So one of the most common things that I see is husband and wife have some single-family residential rental homes that they're in the process of selling, and they think to themselves, well, if I do a 1031, then I have to reinvest the sale proceeds into other single-family residential homes, and that's not true. The IRS has a very broad definition of what like-kind means, and so you can go from single-family to multifamily. In fact, that's one of the reasons why I encourage people to think of, if you're going to sell even a commercial building, to go into multifamily. Multifamily, I'm a big believer in it. It is, in my opinion, one of the safest asset classifications out there for investors today in the marketplace. It is one of the only asset classifications that is what we call non-recourse debt. It is not something that you personally guarantee with all of your net worth. The tax code has allowed us this magical section of 1031 and the ability to sell an investment property. Remember, this is not a property that we're living in personally, but this is an investment property. We sell it, and then we replace it with little or no tax liability on any resulting gain, preserving the sale proceeds for the purchase of another property. The bottom line is this helps investors. It absolutely is one of the most beautiful things in the IRS tax code. And how many people can actually say there's anything beautiful in the tax code? Here are the easy rules for you to remember in connection with a 1031. All cash proceeds from the sale of the relinquished property. The relinquished property is the property that we're selling, must be reinvested in the replacement property. The replacement property, and for purposes of this presentation, is the apartment building. So we're selling our single-family residence homes, our rental homes, or we're selling our commercial homes, or we're selling vacant investment land, reinvesting the gain that we have on that in the apartment building. Or if we don't do that, we're going to pay tax on the difference. The purchase price of the replacement property must be at least as much as the sales price of the relinquished property, or you're going to pay tax on the difference. So easy rule of thumb, you got to buy something that is at least what you sold or bigger. At least or bigger is what you want. The purchase of the replacement property must be the same as the seller of the relinquished property. A lot of people now in the days of asset protection think to themselves, if I'm a husband and wife and I own rental properties and I sell that and I want to reinvest that into like an apartment building, do I have to own that as husband and wife? And the answer is no. You can create what we call a disregarded entity. A disregarded entity is a limited liability company. You can do that. So for safe harbor protection, the last point here on the easy rules is we're going to always use what the IRS calls a qualified intermediary. That is the buffer between you and the IRS. So there are entities. So when you sell the property, whatever property you're relinquishing, and you're going to replace it, the qualified intermediary takes possession of those sale proceeds, and they're going to actually facilitate the sale and the transaction into the replacement property. And that's what the IRS calls a safe harbor, meaning it's safe harbor from having to pay taxes.
Yeah, the 1031 portion, you have to do that before you close. So you have to bring that the qualified intermediary in at closing. That has to be part of your closing agreement. So if you're going to 1031, you have to introduce them into the process of your closing.
Grocapitus has wonderful relationships with qualified intermediaries that they can refer you over to, people that understand real estate syndication, understand passive investors and how they can invest into multifamily. If you're trying to figure out who to go with, and Grocapitus will be happy to help you out. This gives you an idea of how the 1031 exchange timeframe works. So day one is the day after escrow closes on the relinquished property. That's the day that you sell your property. You have 45 days within which to identify the replacement property or properties that you're going to reinvest that gain into. And then you have to close on that transaction within that 180 days. So 180 days is the deadline to actually purchase the replacement property. So you can see how this can kind of be a team effort, because these are very rigid rules. The IRS doesn't bend these rules for anyone. The timeline, you really need to know that your qualified intermediary will absolutely know this. This is one of the foundational things of any 1031.
Related to a disregarded entity, the question is, can they use a land trust?
They can use a land trust, particularly if you have, as long as the IRS considers it a disregarded entity. However you held title in the land is how you can purchase or use those proceeds into the replacement property.